Welcome everybody. In this video we will talk about the derivatives. We will start with a brief introduction on these instruments. They can be used either for hedging or speculation. Derivatives are financial instruments whose value is not autonomous but derives from the price of an underlying asset. The underlying can be real, such as raw materials, wheat, gold, oil, etc., or financial, stocks, bonds, exchange rates, indices, etc. The derivative term indicates this dependence. The main reference of the derivative is the price of the underlying instrument. Derivatives, like options and futures, have an expiration date. Stocks instead do not expire. The origin of derivatives stems from the trading of raw materials, and in particular from the need to protect the delivery of goods. The main function was typically to cover the risk of any unexpected fluctuation in prices due to various causes. Over time, derivatives have mostly changed this function. From hedging instruments, they are now used for speculation. In fact, they have another property that can be used for the leverage. This means that an investment in derivatives can have significantly higher profit margins than an investment of equal value made directly on the underlying asset. For our purposes, we divide derivatives into two broad categories: futures and options. Futures are very simple tools to understand. They are forward contracts, that is, they are an agreement between two parties in which they trade a quantity of an underlying at a forward price and at an expiration date. In other words, two counterparties fix a price and a quantity now, and they postpone the delivery of the product somewhere in time. The buyer of the future contract opens a long position. He undertakes to pay a price at a certain date to receive the underlying asset. The seller opens a short position. He undertakes to deliver the underlying asset in exchange for a price at an expiration date. For example, let's imagine we want to buy 100 liters of oil. We can directly buy the asset. We find out the average price of the oil, and then we go to the oil mill. We agree on the price with the producer, we pay, and immediately take our 100 liters of oil home. On the other hand, we can propose an agreement to the producer. We agree that 3 months from now we will pay the price and take the oil. At the same time, the producer agrees to deliver us the oil exactly 3 months from now at that price. The seller and the buyer make a contract in which the two parties undertake, one to deliver and the other to pay the price for the product on the set date, let's say $10 per liter, within 90 days from now. To guarantee the contract, the two counterparties rely on a third party, which could be a notary or an arbiter, to whom they pay a deposit, a percentage of the total amount that was agreed, or margin. If the producer owns the oil in its stock, he does not have the obligation to pay the margin. In fact, the producer is performing a covered sale from the warehouse. If the man has not produced the oil yet, the arbiter will require the margin, as the sale is not covered by the oil in stock. Paraphrasing this type of future contract in the derivatives market, we will say that the seller opens a short position and the buyer opens a long position. The 3 months agreed for the delivery pass. At this point we can have some scenarios. If in the meantime the price of the oil has increased by $2 per liter, from $10 to $12, the buyer would have made a great deal. Instead, the seller, who has exactly a mirrored position, would have realized the so-called lost profit. This is very clear. If the price of the underlying rises, the one who bought the future makes a profit, while the one who sold the future takes a loss. Obviously, it is the exact opposite if the price of the underlying asset falls. For example, if the price falls by $2 and goes from $10 to $8, the buyer makes a bad deal, while the seller makes a profit. It is important to point out that this kind of contracts are zero-sum, that is, the gains and losses mirror themselves. If the buyer earns $2, it means that the seller loses $2. It will never happen that one gains $2 and the other loses $1. The numerical ratio will always be the same, only the plus or minus sign in front of the number will change. Thanks for your attention. Let's get over another video.